So Andrew, in our previous videos, we talked about how a traditional 401k was different from a Roth 401k if your employer actually offered one. And so today we're going to talk about how a traditional IRA is different from a Roth IRA outside of your employer. So I know there are a lot of rules and different types of vehicles that you can be presented with when you're trying to save for retirement, but that is why you want to hire a professional to help keep you in line with how these different plans may work for you. And so if you're thinking about having a traditional IRA or a Roth IRA or both, well, stay tuned to this video so we can educate you more about the similarities and differences between the two. Hi, my name is Carson Graves, President and CEO of the Retirement Education Center.
And my name is Andrea, Director of Operations at the Retirement Education Center. And the reason we've created these educational videos is to help to make the difficult and confusing retirement process simple.
Absolutely, and we do this by incorporating a team of strategic partners ranging from certified financial analysts, certified financial planners, estate attorneys, insurance advisors, and other needed professionals to help us build a comprehensive and holistic retirement roadmap that's going to let our clients know when, where, and how they can reach their retirement goals.
For specialized strategies on how to maximize your retirement income, please subscribe to our YouTube channel and hit the notification bell to be notified when we upload new videos.
So Andrew, as we continue our discussion on the different types of retirement accounts that people can choose when they're trying to put away money for their retirement, two of the most common types of accounts that you're going to be confronted with out there will be a traditional IRA and a Roth IRA. And so millions upon millions of Americans actually contribute or have money in these types of accounts. And so the question, as always, is going to be when, where, and why should you do one over the other. So we're going to be talking about these two accounts today in our short educational video to give you some insight into how you may think about utilizing one or both of these type of accounts for your retirement situation. But before we get into that, there are two rules to retirement income that we like to give you. And Andrew, what are those two rules?
Well, rule number one is to never run out of money. And rule number two is to never forget rule number one.
So let's go ahead and dive into our discussion today on whether a traditional IRA or a Roth IRA may be a better suit for you. So now we want to talk about a Roth versus a traditional IRA. We know that there are a lot of planning tools out there, and of course these two accounts a lot of times can become confusing to a lot of people, and so we want to try to educate you so you can make better decisions out there when you're confronted with whether you should do one or both of these type of accounts for yourself. So for 2021, and I say for 2021 for one reason and one reason only, a lot of times the rules of these accounts, they change on an annual basis. So for 2021, this is what we know. This is how they are definitely similar. So we're going to talk about the similarities and the differences here. Both of these accounts can have a penalty assessed to them if you take them out before age 59 and a half. And usually for a Roth IRA, that means earnings only. But if you take money out before age 59 and a half, just know that both of these accounts can have a early withdrawal penalty of 10% assessed to it, plus also a taxable situation if you take them out before age 59 and a half. So there is an income requirement also for both of these accounts. So you must have earned income in order to contribute to a Roth IRA or a traditional IRA. And the amount that you contribute to that account has to be at least equal to the income. So for instance, if you made $3,000, you took a part-time job, you made $3,000 that year, you can't contribute more than $3,000. You can only contribute that amount. So just keep that in mind. That is a rule for both of these accounts. So the maximum amount of dollars that you can contribute to either of these accounts for 2021 is $6,000 or $7,000 if you're 50 and older. So both have the same exact catch-up clause of $1,000. You can also do what they call a spousal contribution for either of these accounts. So that means that you as a spouse, if you're working, can contribute to a non-working spouse. So here's a really quick example. You have Mr. I Don't Know, he's working, and Mrs. I Don't Know is a stay-at-home mom. He can put $6,000 into his traditional or Roth IRA and also open up a traditional or Roth IRA for Mrs. I Don't Know and contribute $6,000 as well. So we've talked about some similarities, but let's talk about some differences because there are definitely some differences between a Roth and a traditional IRA. One, with a traditional IRA, the contributions are deductible, but there are certain limits to that. And we're going to cover that in our next slide. But you can take deductible contributions when it comes to your traditional IRA, but there are certain limits in which you cannot have any deductions when it comes to traditional IRA contributions. And also, these are paid with pre-tax dollars. Therefore, of course, in your retirement or anytime you're going to take money out, it's going to be taxed on the back end. When it comes to a Roth contribution, it is a non-deductible contributions and it is made with after-tax dollars. Non-deductible contributions. A traditional IRA distributions are taxable, as I mentioned, on the back end. Rollovers are the exception. Rollovers are not considered distributions. So if you do a rollover to another IRA, or if you do a rollover inside of your 401k, if it allows it from a traditional IRA, that is not a taxable event. Roth distributions on the back end are tax-free as long as you follow the rules about that. So you have to have held that account for 5 years and you need to be past 59 and a half in order for that those distributions from a Roth IRA, in what they call qualified distributions, you have to meet those requirements in order for that distribution to be tax-free. Just keep that in mind. We have done videos about this, and I encourage you to go check out our videos on the 5-year rule when it comes to Roth distributions. So a traditional IRA also has a required minimum distribution rule. So you have to start taking money out of your traditional IRA at the age of 72. Now, the old rule used to be age 70 and a half, but under the new law, under the Secure Act, they have now pushed that age back to age 72. If you want to know more about the Secure Act, I do encourage you to go watch our video on that as well so you can get more insight on this. But with a traditional IRA, you have until age 72 until it's mandatory that you have to start taking money out of that account. With a Roth IRA, there are no required minimum distributions. That is sometimes a thing that many people like about a Roth IRA is that there is no mandatory date in which you have to start taking any distributions. And so that money can kind of sit there and continue to grow as long as you like. So who might choose either a Roth IRA or a traditional IRA? So let's go through a few examples of seeing who might choose which type of an account. First of all, if you're in a higher income tax bracket, you might want to think about doing a traditional IRA for two reasons. One, you may believe that you're going to be in a lower tax bracket in your retirement. So it may be prudent to actually defer those taxes now while you're in a higher income tax bracket. And when you're in a lower income tax bracket in your retirement, that would be a more advantageous thing and a more strategic thing to do if you're actually making a higher income at this current moment. So a traditional IRA might be a good fit for you in that regard. Now, another reason is that when it comes to a Roth IRA, it has income limits. So not everyone can contribute to a Roth IRA. And you can look at the limits here. If you make over $140,000 plus as a single person or over $208,000 as a married person, you can't contribute to a Roth IRA. So you have to choose a traditional IRA in that scenario. Understand you can do a backdoor Roth. So no matter what your income is, you can't get into a Roth. And so if you don't understand what that is, of course, we made a video on that as well. And so I encourage you to go check out our video on how to do a backdoor Roth. So there are income limits to a Roth. There are no income limits to contributing to a traditional IRA. So what about if you wanted some tax deductions? That is a really important deal for a lot of people to make sure they can lower their taxes and have that deduction there. You're certainly going to want to choose a traditional IRA because a Roth is not tax deductible. But here's how you can actually get this tax deduction because it's not across the board just because you're doing a traditional IRA. So here's one way you can do it. You can have a tax deductible traditional IRA. So if you and or your spouse are not covered by any type of plan, like a 401k or any type of deferred comp plan at work, no matter what your income is, you can deduct your contributions to a traditional IRA. Understand that. Neither of you need to be covered by a plan. then that contributions to your traditional IRA is fully deductible. Now, if you are married, filing jointly, and you are covered by a plan, if you are covered by a plan, and both of you are actually in a 401k plan or some type of deferred comp plan, 403b, 457, then if you make over $125,000 or more, you cannot deduct. You cannot deduct any of those IRA contributions from that traditional IRA. If you're married, filing jointly, and only one of the spouses, if only one of you are covered and the other person is not, if you make more than $208,000, you cannot have a deduction. So if only one of you are covered. Now, if you're single or head of household and you have a covered plan, if you make more than $76,000 a year, that means you have a 401k plan and you make $76,000 or more in 2021, you cannot deduct those contributions from that you make to a traditional IRA. And of course, if you're married, filing separately, and you have a covered plan, and you cannot make any more than $10,000 or more before the deduction is not allowed for that traditional IRA. So these are some of the rules that you have to look at if you're thinking about having a tax deduction and choosing to do a traditional IRA for that reason. Now, if you're looking for tax-free income in your retirement on the back end, then obviously, we've discussed this before, then you're going to want to choose a Roth IRA. Understand, if that Roth has been held for 5 years and after age 59 and a half, these requirements are the critical things you have to look at. You can pull money out of a Roth IRA after it has grown tax-free. You can pull money out of that Roth IRA on the back end tax-free as well. And if you want more control over your retirement income, then again, a Roth IRA is going to be more in line to what you're going to be looking to do versus a traditional IRA. Because why? There are no RMDs. So you can let that money grow as long as you want and pull that money out whenever you feel necessary. Also, contributions to a Roth IRA, your contributions, not your earnings, they can also be extracted at any point in time. So you do have more flexibility with a Roth IRA than you would with a traditional IRA. So these are definitely things that you're going to want to consider. And of course, no matter what your situation may be, you're going to always want to consult with a financial advisor or a tax advisor to make sure that you're able to make the appropriate decision for yourself. So I hope that this information was insightful in helping you understand the differences and even similarities between a traditional IRA versus a Roth IRA. Please remember that the information that we share with you in these videos are for educational purposes only, and always consult with a financial advisor or a tax advisor about your own personal situation. For more information about this topic or any of our topics that we've discussed in our other videos, please feel free to reach out to our office and or leave comments in the comment section below.
To learn more about our services and how we can help you to increase your chances of not outliving your retirement income, please make sure to click on the link in the description below and sign up for our free Maximizing Your Retirement Income Masterclass. After this video, please check out our other videos that we've created that will give you tips on how to maximize your retirement. Also, if you like this video, please give it a thumbs up, subscribe to our YouTube channel, and share it with a friend. Thanks for watching, and remember, if you have questions,
we have answers.